Good morning, ladies and gentlemen. I'd like to welcome everyone to our 31st annual Gabelli Commercial Aerospace and Defense Symposium. My name is Tony Bancroft, and I'm joined by my colleague Michael Bergio and Daniel Gleim. I've been with the firm for 14 years covering aerospace and defense as well as environmental services, and flew F-18s in the Marine Corps previously for about 15 years. Michael has been covering the industry for about 4 years, and Daniel recently joined us and has covered European aerospace and defense for about 12 years. Okay, we believe this is a fantastic time to host an aerospace and defense conference, given the dynamics playing out as commercial flying recovers and geopolitical uncertainty remains globally. Today, some of the companies we are hosting bridge both dynamics. But before I begin, I'd like to briefly go over the commercial aerospace and defense industry. Okay, before I go any further, you'll see this slide again, illustrating the long-term demand projection for the commercial aerospace industry, which gives a good backdrop for the rest of the discussion. Although COVID had a severe impact on global commercial air traffic in the near term, the longer-term outlook remains relatively intact at about $14 trillion, or about $700 billion annually, addressable market over the next 20 years, $9 trillion in airplane production, and about $5 trillion in services. All right, let's start off about talking about the last 20 years. Airbus and Boeing both expanded commercial aerospace markets with planes like the A320 legacy and the Boeing 737 legacy. The industry has been driven by mostly aluminum planes with smaller, less efficient engines. Over the next 20 years, you'll see planes that are more fuel efficient with 50 to 60% carbon fiber and specialty alloys like the A350 and the Boeing 787. Before we get to that, though, we have sort of three near-term dynamics in the industry I call the three Bs: backlogs and build rates, business travel, and then Beijing tariffs. Backlogs or supply chain backlogs, to be more specific, are hindering production rate increases. Boeing CEO Kelly Ortberg has stated that ongoing perpetual in nature periods of production rate increase will be hampered by supply chain limitations. On top of that, the FAA is expecting to keep Boeing at 38 per month on the 737 in the near term. Secondly, business travel has been impacted by COVID and its variants. Business travel is only about 12% of actual passenger traffic, but up to 75% of profitability for certain airlines. It's expected that corporate air travel spending will not return to 2019 levels until after 2026. Currently, corporate bookings remain 20% below pre-COVID levels. The industry has evolved to somewhat of what we call bleisure travel, where employees are tacking on vacation to business trips. And then thirdly, and probably most importantly, is Beijing tariffs and the uncertainty that remains around that. Although China has resumed deliveries of Boeing planes in 2025, recent talks of a Boeing 500 plane order have been noted. It is speculated about half the planes, or about 1,000 planes in Boeing's backlog, are going to China. So there's some near-term potential optimism. Okay, here's a China fleet breakdown, about 120 planes on back order that are actually officially on the order book, and about 800, 900 of those orders that are going to be going to China from other sources through unidentifieds. But more importantly, there are about 20% of the expected future orders for the global fleet, and will need 9,000 aircraft over the next 20 years. Okay, as you can see, travel resiliency over the long term has historically been stable, despite geopolitical and financial market challenges and global pandemics. Obviously, compared to others, the COVID was more impactful, but air travel has actually surpassed on a passenger basis pre-COVID levels. This summer, TSA recorded the highest travel numbers ever. Over the 4th of July weekend, the highest ever one-day travel actually occurred. So where does this lead us? The long term. Over the long term, global commercial travel fundamentals that have driven air travel for the past 5 decades and doubled air traffic over the past 2 decades remain intact. This is mainly driven by over 300 million people entering the middle class in China and India over the next 10 years. And this turns into a multiplier effect with more consumer spending that directly relates to more air travel. Global revenue passenger kilometers, or RPKs, are expected to grow from 8 trillion in 2023 to 21 trillion in 2024. Airline market liberalization, deregulation continues to stimulate growth, while governments are investing in infrastructure, new airports, and allowing for increased capacity. Technologies improved air traffic control, rerouting, airport management, gate optimization for longer working hours, and the low-cost carrier model has reduced ticket prices, allowing for more passenger traffic. So here we are looking back and looking forward. The CMO in 2004 expected 25,000 jets to be delivered. The max grounding in COVID accounted for about 3,000 lost jets delayed from 2019 to 2023. So it actually turns out the CMO is pretty accurate with that forecast. But let's talk about the first slide that I showed, the earlier slide I showed. The global fleet is expected to grow by almost 27,000 planes to 50,000 over the next 20 years. About 44,000 new planes will be needed for growth and replacement. Of that 44,000, most will be going to single aisle, where we're seeing, essentially the current entire fleet will be matched by the amount of growth over the next 20 years just in single aisle alone. The backlog, although we've seen some cancellations and deferrals from customers, overall the net backlog has grown has actually grown during COVID. There's still about a 10-year plus backlog at normalized rates. Airbus has almost 9,000 planes on order. Boeing has 6,500, and I added COMAC this year with expected of 1,200 plane backlog. To go through the numbers quickly, both Boeing and Airbus had lower production rates through COVID, but they're coming back. This has turned around. Airbus looking to increase 320 production to 75 by 2027, and A350 to 12 by 2028. On the Boeing side, Boeing has struggled since the January 5th incident, but improving their quality, looking to try to get to 42 by the end of this year, maybe early next year, and the 787 is at 7 now, going to 10 by 2026. So here's our forecast to finish up. We expect about 800 Airbus planes to be produced this year and about 500 Boeing planes. And COMAC, although started out very slow, expected to have almost 50 this year. Okay, I'd like to switch to defense spending briefly. The defense budget grew by about 20% over the last 5 years, or about a 4% CAGR, driven by much needed spending due to increasingly volatile geopolitical environment. The Defense Department expects budget to grow at about a 1.5% CAGR over the next 5 years. This has been a consistent trend of defense spending outpacing forecasts during high geopolitical volatility as we have today. And remember, U.S. defense spending is still well below historic numbers of about 6% of GDP. We're at about 3.5%, a little less than 3.5%. On a global basis, defense spending has increased 20% in the last 10 years to over $2 trillion, with the U.S. having the lion's share of almost $900 billion or $1 trillion this year for the first time in 2026. China has over doubled its defense spending in the last decade and could be on pace to eventually match the U.S. This number is misleading as it considers spending on personnel, and if backed out due to lower wages in China, would likely show much higher spending on growth and on procurement pari passu to the U.S. ex-labor. All right, so with NATO, you can see that if NATO countries were to spend at 3.5%, which they've stated, and Daniel's going to talk about more in depth, of GDP, that'd be a $400 billion increase in global defense spending. That's a 25% increase. All right, now I'd like to invite my teammate up, Daniel Gleim, to talk about global European defense spending. Daniel.
So thank you very much. Good morning, everyone. So we start with a recap of the historic NATO summit in The Hague. NATO Europe committed to spending 5% of GDP on defense, 3.5% on core, and 1.5% on infrastructure. That compares to more than 2% core before, and an actual spending of 1.5% on average before the invasion of Ukraine. NATO Europe spent around $485 billion on core defense in 2024. The key contributors are Germany with $100 billion, or 20%, followed by the UK and France. We estimate core expenditure to grow at the low teens CAGR and to reach 3% of GDP by 2030. Core expenditure can be further divided into two main segments: military equipment and other, which is mainly personnel. In 2024, NATO Europe spent around $155 billion on military equipment, and we estimate the equipment share to rise sequentially, and equipment expenditure therefore to grow stronger at a mid-teens CAGR until 2030. Germany is the key growth driver of European defense, contributing more than 25% of absolute spending growth. Visibility is also high because after the NATO summit, already Germany released its core defense budgets for the next 5 years. Therein, Germany plans to reach NATO spending target 6 years early, with 3.5% of GDP in 2029. Germany also just published an equipment budget draft for 2026. This includes 48 billion in actual equipment spending, but more importantly, also a spending authorization for 325 billion. This means Germany can commit to order volumes worth 8 times the annual spending in the short term. Key positions are vehicles and ammunition, and in my view, the magnitude of this order pipeline is likely to act as a catalyst for European defense. So we look at a very lively fall. Germany is to brief the primes on all expected deliveries until 2035. In September and November, there will be the formal approval of the 25 and 26 equipment budget drafts. And in November, with this visibility, there will be several capital market days with new midterm targets. More details on European defense can be found on our white paper, which is also available on our website. So in summary, global aerospace and defense is running on all cylinders across both verticals. Civil aerospace is expected to continue growing with over 10 years worth of backlog, and the defense industry is to witness a 10-year plus super cycle driven by higher NATO spending. So let me quickly walk you through today's agenda. We start with Textron, followed by Moog, HEICO, and Crane. Then we look at Elbit, Standard Aero, Albany International, and Ducommun. There will be a lunch at 12, followed by Astronics, New Horizon, and Graham Corp, followed by Rheinmetall, Curtiss-Wright, Redwire, and Drone Shield. And we close off with Aero Group, TAT, Bridger, and Astronav. And finally, Apex Aerospace. So we have a presentation format followed by Q&A. If you want to raise questions, please raise your hands during the Q&A session. And if you follow us by Zoom, please use the chat function. Our team will then ask the questions.
Tony Bancroft is a portfolio manager for Gabelli Commercial Aerospace and Defense ETF. Michael Bergio and Daniel Gleim are research analysts at Gabelli Funds. The above webcast is a recording from the 31st Annual Gabelli Aerospace and Defense Symposium, which occurred on September 4, 2025. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of June 30, 2025, affiliates of GAMCO Investors Incorporated beneficially owned 5.61% of Ducommun, 2.98% of Graham Corporation, 2.41% of Astronics Class A and less than 1% of Class B, 2.37% of Moog Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. The analysts' views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli 800 422 3554 914 921 5100 fax 914 921 5118 info@gabelli.com. Tony Bancroft is a portfolio manager for the Gabelli Commercial Aerospace and Defense Fund. This ETF is different from traditional ETFs. Unlike traditional ETFs, this ETF will not tell the public what assets they hold each day. This may create additional risks for your investment. For example, you may have to pay more money to trade the ETF shares. This ETF will provide less information to traders, who tend to charge more for trades when they have less information. The price you pay to buy ETF shares on an exchange may not match the value of the ETF's portfolio. The same is true when you sell shares. These price differences may be greater for this ETF compared to other ETFs because it provides less information to traders. These additional risks may be even greater in bad or uncertain market conditions. The differences between this ETF and other ETFs may also have advantages. By keeping certain information about the ETF secret, this ETF may face less risk that other traders can predict or copy its investment strategy. This may improve the ETF's performance if other traders are able to copy or predict an ETF's investment strategy. However, this may hurt the ETF's performance. For additional information regarding the unique attributes and risks of this ETF, see the Non-Transparent Exchange Traded Fund (ETF) Structure Risk, Early Close/Trading Halt Risk, and Authorized Participant and AP Representative Concentration Risk in the Principal Risks section of the prospectus. Exchange-traded funds (ETFs) are bought and sold through exchanges trading at market price, not NAV, and are not individually redeemed from the fund. Shares may trade at a premium or a discount to their NAV in the secondary market. There is no guarantee the investment strategy will be successful. Investing involves risk, including the possible loss of principal. Premiums or discounts are the differences, expressed as a percentage, between the NAV and market price of an ETF on a given day, generally at the time the NAV is calculated. A premium is the amount an ETF is trading above the reported NAV, expressed as a percentage of the NAV. A discount is the amount an ETF is trading below the reported NAV, expressed as a percentage of the NAV. The prospectus/registration statement shows the frequency of distributions of premiums and discounts for these ETFs for the most recently completed fiscal calendar year and all completed quarters of the current fiscal year. Investors should carefully consider the investment objectives, risks, charges, and expenses of the ETF before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800 Gabelli or visit www.gabelli.com. Risks to the ETF include a downturn in commercial air travel, production and/or supply chain disruptions, decreases in defense spending, subcontractor financial health, and competition and/or technology changes. As of June 30, 2025, the common stocks of Boeing, Ducommun, Curtiss-Wright, Moog, 5.55%, 4.54%, 4.26%, 3.69% of the fund's net assets, respectively. As of June 30, 2025, affiliates of Gamco Investors Incorporated beneficially owned 5.61% of Ducommun, 2.98% of Graham Corporation, 2.41% of Astronics Class A and less than 1% of Class B, 2.37% of Moog, Class A and less than 1% of Class B, 1.38% of Textron, and less than 1% of all other companies mentioned. Distributed by G. Distributors, LLC, a registered broker-dealer and member of FINRA.